Welcome to our next session on economic growth, measurement, and forecasts. In our first two videos, we looked at what the mega trends are that will be affecting our world, our firms, and ourselves in the future. They're underway, they're happening. But let's take a look now at what has happened. First thing I'd like to do is give you a reminder, an overview again of the GDP, the gross domestic product. It's a primary indicator of the health of a country's economy. If it's healthy, growing, we see low unemployment, wages increase as business demand labor to produce more, builds confidence. Growing too fast, inflation can be a risk. Negative growth, less jobs, less production, and it creates negative feels. The GDP not only reports data, but it has an impact on feelings, positive or negative, about what's happening in the economy, what has happened, and that may influence spending as we go forward. 2 quarters of negative growth is a technical recession. Now, when we look at it, there's total GDP. It's often expressed as a percent comparison to a prior year or a quarter. What's changing? Is it getting bigger or smaller? Trends are more important than points in time. What is the trend telling us? Which direction is it going? It's very complicated, includes statistics, estimates, other things aren't even counted in it. It's not always timely, preliminary, and then they come out with the final revised one. And we have the revised one for the third quarter 2019 that we'll talk about shortly. This just gives you a sense of the, this was last revised on November 27th. It'll come back out on the 20th, but I'm making this a lot earlier, so we have this number. What are the key things? This is here to give you a sense of what the size of the economy is. That's $21,340 trillion. This is the U.S. economy. Consumer, 14,511. We look at business investment. This is gross private domestic investment. That's buying equipment, structures, equipment, etc. 3.7 trillion. Net exports, which reduces it because we're importing, 662. Then we're looking at government expenditures, 3.7. So we can see the bulk of our domestic economy is consumer driven. Smaller portions are split between domestic investment and government investment. But as you can see, this is relatively small number. It's getting a lot of attention when this is being the big one. So this is to give you a relative size and how things are broken down. Key for you is the size. And if we look here, this is a quarterly chart that goes all the way back to 2005, and you can see that there's a lot of up and down. There is not always a clear pattern. We clearly saw the Great Recession here, but in this period here, we see up, down, up, down, up, down, and that is continuing as we get into, we were relatively flat for about a year. Went up. I think the highest we hit was about 375, and then it dropped down, up, down, and we'll see where it's going. So it's there's no discernible pattern other than it's been up at this moment. Now, when we look at it, this shows graphically how much the consumer is part of the GDP. Okay, so you can see that it's the big driver of the whole thing is personal consumption. And it's been it's going up, but very slowly. This is driving it. You're seeing it again. Another chart, another way of looking at it is that the consumer is spending. On to the future. This is Bloomberg, Goldman Sachs investment research. And what we're seeing is that in the U.S., the Goldman Sachs estimate is 2.3. The consensus of all analysts is 2.3. As we move into 2020, Goldman Sachs sees 2.3. The consensus is 1.8. In 21, 2.4, and 1.9. So we have a pretty big, Goldman Sachs seems to be much more optimistic for the U.S. economy than do everyone else. But we're in a range. This is not a science. Different things will happen. But we're looking at, I think you can safely say, around 2% growth for the next 3 years. Nothing spectacular. And this breaks us down by different countries. These are the developed markets. And as you can see, the developed markets, everybody's pretty much in line. But now look at the emerging markets. So the world economy is going to grow at 3. Most of that's the emerging market growing at 4.2. That's twice the size, if you look, as the U.S. economy as far as acceleration. And it is going up much more. So that's the outlook for the future. We need to be cautious on using the GDP. Because it's oftentimes looking in the rear view mirror and making forecasts based on that. And I don't think, in my opinion, and that's one thing you're going to hear is when I have a specific opinion, that I'll say, in my opinion, GDP has failed to, I don't think it's really captured the impact of technology and improvement in lifestyles of our population. I think there's many other indicators that can be used to understand the health of one's economy, making it complicated, whether they be economic indicators, environmental indicators, or social. But most people focus on the one big thing. We need to be careful. We have so much information. We have forecasting and nowcasting. At times, we are measuring economic growth in real time and crowdsourcing information. This is, as we approach Christmas time, there's many firms sending out drones taking pictures of parking lots to estimate what retail sales are going to be. So it's trying to process all that information, which has been used by artificial intelligence, algorithms, and others. As individuals, it's hard to keep up on all of that. Now let's move on a little bit to the employment situation. And as you can see here, our unemployment is very, very low. It's 3.5%, which is, when you think about it, this is almost a record low. This is almost full employment. There'll always be people who will be unemployed because of switching jobs, coming out of school, firms closing. But this is really an amazing number. When we look at that, though, we have to take this within the context of the number of people participating in the workforce. And as we can see, we're just a little better than 63% of the population is in the workforce. That essentially means that excludes those that are children, those of you that are going to college, and those that are retired and not in the workforce. So as you can see, there's significantly less people working today in the labor force than in the past. So we got to take this number up here within the context that there's less people in the workforce. On a very positive note for you, this takes a look at 1992 through 2019. And all this information comes to the Bureau of Labor Statistics, and jobs numbers come out on the first Friday of the month, which we've already had. So when you look at those that have looked by educational achievement, we see that bachelor's degree and higher is almost at 2%, but take a look at what the decline has been right up here in those with less than a high school diploma. This is where when we look at those employment numbers, these are the folks that are becoming employed. So when we look at these here, we never were real high. So if you look at this, it's come down, but not the same proportion. Let's take a bit of college education. This is sort of just to give you a sense of where we've come as a country. In people in America having a 4-year degree or higher, in 1977, it was about 34% of the population. Today, it's about 38%. So at this point, over these 40 some years, we haven't seen a substantial increase in the number of people that are college educated. By state, it varies tremendously, 28% to 50%. New York is 50%. We look at that there's currently over 7 million unfilled jobs, and they're unfilled because of a lack of skills. Okay? And I think you can tie this back. Now, what your degree has will dictate your future. How are we standing up to the rest of the world? Canada, 56%. Japan, 51%. Israel, 50%. Korea, 47%. So when we think about this, at 38, we are not the highest. We are not the most educated country in the world. Other countries far surpass us. And here's the looking of where jobs are. And these are the job openings, and we can see them increasing dramatically. And I think if you look at this graph versus the unemployment graph, that tells you an awful lot. Now, you noticed when I talked about that one graph that we saw those without an education going down. I found an article that I was reading, and I think we need to think about what's been happening, and this does have tie back to both organizational behavior and corporate finance. So let's start with what's the premise of this. It's by Martha Ross and Nicole Bateman from the Brookings Institute, a research group. And what they found is they broke workers down into mid and high wage workers and low wage workers. And I think when we look at this, I'm not going to put it into a big thing, but let's come right here. Annual earnings. Low wage workers, which are 43.7%. Median annual earnings are $17,953. $17,953. 54,410 on mid to high range workers. So we have this 56.3% are medium to high, 43.7. But when you think of that, are low wage earners. And it does, yes, those that are younger tend to make less. But come back here for a second. These were the people that were entering the workforce. But they're still not making as much money as those that are mid to high. And I'd suggest when you look at this number, there's a high correlation, low wage workers and level of education. Level of education doesn't necessarily mean having a college degree, but it is having a skill base. So you look at this, it's really a fascinating thing to look at. Many of you make more than that where you have done internships and such. But this is really, we're seeing this change in our economy. So that's the summary of the current things that are going on. So we've taken a look at the GDP, current, what makes it up, where it seems to be heading, and we took a look at the labor statistics, which seem good, and then we look at this low wage workers, which is really a key piece. I'm also going to post the entire presentation from the Brookings Institute if you'd like to get into more detail. Just to take a look at another piece of information. This is data, and I am summarizing data, trying to put it within a context of how do we look at this information so that the firm can take actions to be successful in the future and how you can be successful. This is when we look at real average after-tax and transfer income, all in 2018 dollars. So we've taken out inflation. We see that the bottom 50% of workers have seen a 41% increase in wages from 1970. So that's taking you almost 50 years. So 41% increase. When we look at those in the 50 to 90, 72. Now we look at the top 10 to 90, this would take you to 99, 105. But the top went up 205. And as we start nailing it down, we see that those who were wealthy grew even more. So the gap, if you will, between the bottom and the top has expanded. Okay? So some of this is what's driving some of the GDP growth, driving the wage growth, but important thing to take into account. So that gives us a good summary, I think, of what's happening, what the GDP is, that it represents the potential economic health of the country. We saw what it was. It's made up primarily in the U.S. by consumer spending. Consumer spending has what's been driving that. We took at the labor statistics, and we've seen that unemployment is very good. We've seen that the labor force participation rate has dropped. We have seen that those that are more educated seem to have a lower level of unemployment. There's 7 million unfilled jobs. And then we have this low income versus medium high income. And then the real average after tax transfer, when we see 41% in the bottom 50 have gone up in real terms. And as we move up, we see that that has changed, and those that at the higher levels clearly have seen an increase. Much of that could come from the financial markets. So that concludes this section. The next section, we'll talk about policy impact.